club takes pleasure in attracting a stellar list of speakers that address today's most relevant issues. The club's place as a refuge for rich discussion and networking has never wavered after 123 seasons.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, and thank you for joining us. My name is Martha Durden, and I'm a director of the Canadian Club of Toronto. Today, we're joined with Mark Machin of CPP Investments and Michael Katchen of Wealthsimple for a discussion looking beyond COVID and how Canadians will build financial literacy and financial resilience at every age and every stage of their lives. So before we dive into today's topic, here's some information about how to participate with us. The click here to switch stream button helps you find your internet if your internet is slow. The video quality may decrease, but the audio quality should remain strong. Once you click the questions tab, you can enter your questions in the window and they will be sent to the moderator. The request help button located in the bottom right corner of the page is for technical support. Thank you to today's event sponsors, the Canadian Credit Union Association, the Canadian Bankers Association, and PwC. Thanks to their general support, and today's event will be free of charge for all attendees. The Canadian Club is a non-profit, and we have been gathering people together for 124 years. It is because of our sponsors that we can continue to do that. We're grateful for your support of today's discussion. Now, let me introduce today's speakers. Mark Machin is the President and CEO of CPP Investments, and Michael Katchen is the founder and CEO of Wealthsimple. Mark and Michael will be joined in conversation by Anita McOuat, National Leader, Technology and Media, Telecom and Consumer Markets for PwC, and this year's President of the Canadian Club. Welcome to our guests. One of the club's traditions that has not changed in this virtual world is a toast we make to our country. Usually done in person with the raising of a glass, let's make a nod towards the screen and toast Canada. To Canada. Anita, I'll turn the Canadian Club virtual podium over to you. Thank you.
Thanks, Martha. And thank you, Mark and Mike, for joining us today. Based on the number of people that have tuned in, I think there's a lot of interest in this discussion. So we have a lot of ground to cover today, and viewers, please send your questions as we go. They're coming to me directly, and I'll try and sprinkle in as many as I can. So, Mark, I'm going to start with you, and we're going to start with a macro question, which is, CPP Investments invests around the world, truly global organization. So, can you tell us how you're thinking about the outlook for the global economy and how Canada figures into that comparatively?
Sure. It's a huge pleasure to be here today with you and with Mike. And so the world is obviously being hit by this unprecedented COVID crisis. And that's caused a dramatic hit to income around the world. So companies have been constrained in terms of having customers. The economy has been constrained around the world, and there was also in many parts of the world, including Canada, governments encouraged and in some cases forced various forms of lockdown. So there was a huge decrease in income and then a massive replacement of income that happened from what some people are calling MP3, this combination of both monetary and fiscal policy. And fiscal policy in particular has been really quite dramatic. In the US, I think it's the biggest replacement of GDP. It's about 8% of GDP. Even so far, even though we're all waiting for another stimulus package, it's still a massive percent of GDP that's been replaced here. And in Canada, I think it's about 5% of GDP that's been replaced by fiscal stimulus. So that's what's going on. And unfortunately, it isn't going to be over until the public health crisis is over, and that's not going to be over until either there is some broadly distributed and available vaccine, or there's some effective therapeutic. And unfortunately, on the therapeutic front, that's sort of the less encouraging side, in that there's really only one effective therapeutic in dexamethasone, which is sort of late stage. Remdesivir is very marginal. All the others are very marginal. The only one that really is very powerful is the one that President Trump got, which is a very expensive combination of two monoclonal antibodies. And that basically saved his life. But that's not sort of practical for distribution to the mass population at this stage. So what happens if we have to wait for that event and that recovery? In the meantime, the world's come out of a big trough and is coming back. So we still expect world growth this year to be down about 3.4%, but it's obviously growing quarter on quarter quite rapidly. But we bounce based on how many further lockdowns need to happen as the healthcare systems in various parts of the world get stretched. But based on our baseline, we anticipate the world will bounce back about 6% year on year next year. And Canada, I'd say, is a little bit more dramatic on the way down for this year, and so it's about a 6% over 6% contraction is what we're expecting for this year, and just under a 5% expansion for next year is our base case right now. So Canada's doing okay. I mean, certainly compared to the rest of the Americas, when you look at COVID control, it's doing okay. Compared to Europe, it's doing okay. Asia is the really interesting one, where the Asian economies have really managed this quite effectively across many different countries, not all, but many different countries, and that's going to result in stronger economic growth over time from those economies.
It's interesting, we're doing relatively well on the COVID control, but that may come at a higher economic cost as a result versus those that have opened up maybe prematurely. Okay, Mike, over to you, and thinking about closer to home. We do hear about this K-shaped recovery in Canada, where some people are saving during COVID and in fact really benefiting, depending what sector they're in, and then some are really hurting as a result of the restrictions. What are you observing, and are you concerned about the increasing wealth gap caused by COVID?
Yeah, I think those are great questions, and I just echo Mark and say thanks so much for having us today. Really fun to be here and talk about these important issues. It's such an interesting and terrifying time in so many ways, and there are probably still more questions than answers on that front. I mean, given the unprecedented levels of government stimulus, it is really hard to know how, the end, citizen in Canada, saver, investor is going to fare when a lot of those programs start to roll off. I mean, the data is quite clear that on average, there's been about 11% increase in household disposable income, despite the moment that we're in and the number of jobs that are either disappeared or at risk. And saving rates are at all-time highs, with the average Canadian increase to about almost 30%, saving rate in this lockdown, which is not at all what you would anticipate, given the risk to jobs, given the just unprecedented economic challenges that we're facing. The result of that is we have no idea what it's going to look like on the other end of this. And so what we've seen in our business is because income levels have remained, pretty protected, either because people do still have work or because the government has stepped in, there are record levels of interest in investing. Coupled with just the volatility in the markets, the fact that the markets had such a deep dip earlier in this year, people saw that as an opportunity to get into the market. And, for us, what we saw is in our trading business in particular, a 4x increase in the number of traders in that business in 6 months. And so just remarkable growth as people look to start investing, especially early in, earlier folks who are earlier in their investment careers, so younger people. And I think the question remains is, how is this all going to fare as we get further into this crisis, as the government starts to be more pointed in their stimulus, because we can't just continue to write endless checks, broadly speaking, as this crisis kind of continues to go on.
Mark, listening to that, does that concern you in any way to hear about so many people entering the market during this time? Or is that a positive thing?
Yeah, yes and no. I mean, I think, coming to the top, one of the topics, the reasons, the catalyst for us to be here, which is financial literacy, it's a good thing. It's absolutely great that people are paying attention and thinking about saving and thinking about, thinking about markets and learning. I mean, that's terrific. And it's so, I think, there's always a danger with, when you're new to something and everything goes your way for a period of time, that you think it's simple and easy. I think when trends change, you got to be aware that markets don't go in one direction all the time. And I think. But I think the fact that people are engaged in markets is, not a bad thing at all. I think it's it helps people think about, how they can actually save for the long term and save for their retirement in the long term as well.
On the retirement savings question, in 2006, there were more than 1 in 5 Canadians between 15 and 64 years old. For each person 65 and older. By 2056, so 50 years later, there's estimated to be only 2.2 working age persons for each person 65 years and older. So how are you thinking about that at CPP Investments and helping ensure that the fund is sustainable and
Yeah. So let me start off with the really, really important headline, because I know a lot of people don't spend time on this. The fund is completely sustainable, and don't believe me, believe the chief actuary of the country, who comes in every 3 years and checks is it sustainable over a 75-year time frame. Okay, so that's what we take comfort in is all that independent actuarial work looking at, is the fund sustainable over 75 years. So it's sustainable. And so that's the headline. And it's sustainable, bearing in mind that dependency ratio, as you call it, the number of workers per the number of retirees they have to support, is going to continue to deteriorate over time. That's already factored in, that's anticipated, it's all in the calculations. It is sort of worth mentioning a little bit of history here, because it still resonates even amongst young people about, well, I thought the CPP was in crisis at some point. Yeah, it was in the 1990s. And that's the long sweep of history. So the CPP was actually set up in the 60s. It was set up as a pay-as-you-go. It was set up when there were almost 7 retirees, 7 workers for every retiree. So you had 7 people working for every retiree. So the math worked. And then people started living longer, and they continue to live longer. And, on average, every year, people live 3 months longer since the 1920s, which is an amazing stat and great for everybody on this call, but not so great for pension fund sustainability. And then the birth rate dropped as well. In the late 1960s, going into the 70s, the birth rate dropped. So the math didn't work. So the chief actuary of the country came in the 70s and said, guys, to the governments, doesn't work. Math, you're going to run out of money at some point. Governments did nothing. Came in the 1980s, said, math doesn't work, you're going to run out of money. Governments did nothing. And it came to a point in 1996 where they said, look, if you carry on like this, there'll be zero left in the pension fund by 2015, not a dollar left. And that got such huge attention. It got, everybody was spurred into action. And the government sat down and they did a bunch of things. Well, one thing they did was they restructured the fund. They increased the contribution rate, decreased benefits, so the fund is sustainable. So that's going back to the headline again. Fund is sustainable. Don't worry. This is now anticipated. No crisis. The second thing they did was they created us, CPP Investments. And because from the 60s until the 90s, all that had happened is the money was just invested out of a government department, and it was just invested in Canadian bonds, and that was it. They decided we can do better than that. We can get better returns, but we need to create a separate arm's length, completely insulated from political interference, asset manager that can invest the money, not just in Canadian bonds, but in global assets, get exposure to global capital markets, and be able to decide what's the best way of investing the money to maximize returns on that money without undue risk. And so that's what happened. So we were set up right at the end of the 90s, going to 2000. We started off just investing very steadily and safely and sort of passively. And then in 2007, we became an active investor and our returns have become stronger as a result of finding better opportunities by being an active investor around the world. And I can talk about that. But the good news is, our 10-year returns are in about 10.7% as of June the 30th, and they continue to be in the 10% or so range over a long period of time. And that's what we're doing in creating that long-term value. So fund sustainable.
That is good news. And I think we do have some young people watching today as well. So that's good news for them as well. There is another observation about millennials, and even more so that Generation Z. They're very value driven, and a lot of their economic decisions are tied to social justice issues. And I'm curious, Mike, are you seeing that from your clientele and how they want to invest?
Absolutely. I mean, the one thing I'd want to compliment Mark's point by saying we should all be grateful that the CPP is sustainable, but we should also know it's not enough. It's really important in this financial literacy moment that we not think that you will be able to depend on it completely and solely for your retirement and long-term financial goals. And what we see is absolutely a new generation of investors that are entering the market think about things differently than perhaps their parents' or grandparents' generation. And while returns and achieving a profit on their investments over the long term is important, so are things like values. And similar to their purchase decisions, I want to invest in things that reflect what I believe and reflect the world that I'd like to live in. And this was something we noticed, early on in our existence when we launched our own socially responsible investment portfolios, which have been a remarkable success story for us. And we recently decided to expand on that with the launch of 2 socially responsible ETFs to give a broader range of investors in the Canadian market access to a really thoughtfully designed portfolio that also reflects kind of a social values element to it, which is a fascinating topic we can get into, if it's of interest. But socially responsible investments is also tricky because it means different things to different people. And so designing portfolios that reflect the right set of values is a really tricky topic to get right, but has all sorts of fascinating benefits we've observed where by introducing, one of the big fallacies in investing, which luckily pension funds don't have to deal with, given that you're locked into your pension fund, it pays out at the end, you don't deal with the kind of retail markets, the behaviors that really often get investors into a lot of trouble, panicking when markets are down, getting excited when markets are up. And one of the fascinating values of values-based investing is typically investors remain more disciplined about their investments over the long term. As you introduce something other than just returns to the way they think about their money, they're less likely to do those things like panic, get greedy, And that discipline, now that we're in Financial Literacy Month, is really the thing that separates successful investors over the long term from everybody else. And so that's one of the values we think, and one of the things we think is going to be a major contributor to the increase in interest in socially responsible investments in the retail market for many years to come.
The questions are coming in from our audience fast and furious. So I do want to make sure we get into that financial literacy aspect of it. So let me ask a broad question to you, Mark. Do you think the financial literacy of Canadians is improving, or is it getting worse?
Yeah, well, I actually looked up the facts on this in the last 24 hours just to get refreshed, and based on 2 days, so 2014 and last year, it seems to be improving. So that's a good thing, and hopefully, the experience in markets that Mike's referring to over the last few months, again, hopefully it's improving even more right now. So, it's actually not too bad a news story. I mean, generally, we're trying to create some anxiety and encourage people to be even more financially literate. But, Canada's, 2017 data, it's third in the OECD in financial literacy. It's third in teenage financial literacy. It's the second non-Asian country in terms of math, science, and reading literacy. So in the PISA scores, there's only Estonia that's higher, and I think Estonia is also higher in financial literacy. But it's still in a pretty good place, and it looks like things have improved over time. Even in terms of how people are thinking about retirement, there was CIBC survey very recently where it looks like people about 69% of people are preparing for retirement, and 47% now have calculated how much they need for retirement, which is up from 37% in 2014. So there's a bunch of other stats, but it looks like literacy is heading in a decent direction. Of course, it can always be better, and so these efforts I don't think should stop.
For sure, and I'm curious, Mike, to get your perspective on whether you think there's a role for financial institutions and financial advisors in society to increase financial literacy.
Thanks for the softball, Anita. We have a somewhat controversial, I think, view on financial literacy. It is such an important topic. However, I think that the way we approach it is wrong. I think if you think from first principles, the reason we need so much education about the way financial products work is often because financial products are just too complex. And I think the industry needs to take more responsibility in simplifying the products we build, building more transparency into the pricing with which those products work, and enable people to make better financial choices by default, simply by building simpler, easier to understand products. It's so often the case that people end up in really poor financial circumstances because they didn't understand the products, and that could be something simple as they didn't start investing, even if they could afford to, because it felt overwhelming, scary, and complex until it was too late, and missed the opportunity to benefit from compound interest returns over the very long term. So that's kind of point one, is I think the industry needs to take a lot more responsibility in financial literacy by simply building simpler products. And I think two is the approach we have around financial literacy education focuses almost exclusively on retirement. And while this is an absolutely important topic, if you think about young people that are just entering the workforce, it is really hard to get them excited about retirement. This concept that might be 30, 40, 50 years away. And in fact, there's so much talk these days about, are people even going to retire? So using this concept as the inspiration for people to start taking small actions that will have outsized impact on their financial life is not working. And I think just trying to beat that, and continue to go with that messaging to market is just not the right approach. We need to change the approach with which we use to influence young people to start taking better financial discipline early on. We have some radical ideas about other things we could be doing too, which we can get into if that's of interest. But those are two big points I'd share.
Thanks. And you speak a lot about young people, but I also want to ask about marginalized groups within society. And as there's been a lot of awareness about equity and systemic racism and challenges, what can we do to make sure that literacy and access is available to those groups too?
I think that's such an important point. We started this business with this belief that, if you think about it, financial freedom is one of the great forces for good on the planet. It's really the thing that enables people to live the lives they want and provide the lives they want for their loved ones. And yet the tools to achieve financial freedom are so often inaccessible. You've got to have a lot of money to get access to great advice. You've got to be financially literate to know how to navigate, this world of complex tools. And a big part of our belief behind our business, and I think I'm excited to see more broadly across the industry, is how technology and design can really change the game when it comes to access. How do we build tools that are more inclusive? How do we involve a broader audience of people in designing those tools so that we make sure they resonate and actually come from a place of lived experience in how we build them so that they are appropriate and actually helpful? And how do we use technology to remove the barriers to access, by changing the business model? So, no longer need $100,000 to meet with a financial advisor, because that's the only point at which it's worth their time. But if you only have $10 to start investing this week or this month, technology can make that really simple and cheap. And so these are some of the things that we're really excited about is how to use technology to build more equity and more inclusiveness in financial services.
I have a question on a similar vein for you, Mark, that's come in. And how is CPP Investments thinking about equity, gender and otherwise, in your investment activities?
Yeah, it's a super important topic, and it's important not only because it's the right thing to do, but actually, we and lots of other people have done this analysis show that diversity boards and senior management is correlated with long-term risk-adjusted returns. So in some ways it's an easy decision because we're not trading off and saying, oh well, we have to accept lower returns because we've got to have some diversity to do good in the world. It actually is perfectly aligned. And we've done this, we've done an analysis, we've done a meta-analysis of at least 100 external research reports to prove that. We've done our own analysis with over several thousand securities, controlling for all other aspects. So you're controlling for distortions of different sectors or growth characteristics, whatever. And when you control for all the other factors, you still have this correlation with board diversity and senior management diversity. So I say, so it's something that, because it's really compelling, we take it seriously. We take it seriously in lots of different aspects of our investing. And one that has been a focus for us for the last 3 years in Canada and the last couple of years around the world is on boards. So we will vote basically against boards that don't have women on the board, and in Canada don't have more than 2 women on, or if they have less than 2 women on the board. So it's had an impact. I can't claim it's just us that's had an impact on that. So now if you look at the TSX 60 index, the number of women on boards is almost 30% on the broader. I think the 250 index is it's in the 20%. On the whole listed universe, it's about 17%. But I think progress has been made. I think C-suite of management is not so impressive, and particularly on the revenue producing side is much less impressive. But further progress needs to be made in Canada and in other parts of the world, in particular on gender equity and all the other dimensions of diversity. But it's a key focus for us.
Okay, glad to hear it. Okay, lots of questions coming in. I'll direct this one to you, Mark. Have the types of investments that have been doing well during the pandemic changed from the types that were doing well before the period, and have you shifted your strategy?
Yes, no. I mean, so, I sometimes say better lucky than smart. So there's some things that we have very little exposure to that actually performed quite poorly during this period. So hospitality and hotels, our real estate team globally, we have a very diverse real estate team, but we deliberately, in that case, didn't have exposure to hospitality. We haven't liked the return characteristics of hotels around the world, so that was good. Airports is more lucky than smart in a way. We bid on airports all over the world for many years, and we've always been outbid. So we don't own any airports anywhere, that's where we've got very little. So we got no exposure there, and we got very little exposure to airlines, almost none on airlines as well. So there's certain things where I think we either called it right, or we were not exposed, not for these reasons, but for other reasons. We're not immune to being impacted in some of the investments by the pandemic and social distancing. So things that have sports or theme parks elements to them, they've obviously been significantly impacted. I think in the press you've seen comment on, we had some public investment in cruise lines, and that's been impacted. So what have we done? We've done a bunch of sprints on, okay, so what's really going to benefit from this? And one of the areas is obviously Mike's area. Anything that is online is gone. That's accelerated. The digitization of many sectors is accelerated. Digitization of grocery delivery is mass. That whole sector is really boomed. So there's anything that could go digital, and that's accelerated by 5 to 10 years around the world. Telehealth, teleeducation, all these things are sectors where we've seen huge upswing. The real estate aspect of that, the logistics that supports it, and data centers have been booming. And again, there are areas that we've been focused on. I'd say the second area is where the jury's, how much of this is going to stick. So how much is going to really impact, the $5 trillion question I call it, how much is going to impact office property? How much is going to impact urbanization, people moving out to the suburbs, staying there, how much work from home or flexible where you work and impacts, all of the related businesses around that. So we're watching those trends really carefully. And I think it's going to be down to geographies as well. Some cities are going to benefit, some are not. Some regions are going to develop, some are not. So that's the whole area. And then the third area will be what's going to bounce back? What's going to come back in? One day, are we really not going to go to hotels? Are we really not going to go to restaurants? Are we really, not going to go to theme parks? So we really not going to go on cruise line? These things that, massively impacted right now. But, I tend to believe, unless this thing is, I think it's highly unlikely that it mutates into something that will keep us permanently in this mode. So I think people come back. We're social beings. We love being together. I think we'd all far rather be sitting in a room somewhere doing this rather than distributed on screens. And so we like being in the noisy restaurant where we can't hardly hear the people we're with because of all the noise, because we want to be with a buzz. We want to be in the in the nightclub. We want to be in the movie theater watching and experiencing it with a whole bunch of other people we're not going to talk to. We love that. And so that's what we are. We're social animals. And so I think it'll come back, and there could be really interesting opportunities in those areas.
Mike, picking up on what Mark just said about the technological impact of life with COVID, it certainly accelerated the use of technology, and definitely e-commerce. It was already on the rise, has just completely gone through the roof. And we've all been living and working remotely. So I'm curious to find out how that has impacted Wealthsimple, both as you think about your business model and your clientele, but also organizationally, how you're thinking about it with your employees.
Yeah, there's no question, as Mark pointed out, we have been a beneficiary, unexpected beneficiary of this environment. people can't go to the bank branch or don't want to go to the bank branch and still want to participate in financial services. And so we've, by being a digital first company that offers its services online and on apps, benefited tremendously from that. We saw it with the tax season, where we have a online tax prep software business, as people didn't want to meet with, tax prep services face to face, where we helped over 1 million Canadians file their taxes this year, and just remarkable kind of growth in those digital services. I think the other component you touch on, which is a great one, is culturally. This has been a really challenging time, and it's unclear when that will resolve itself. And I think back to those kind of early days of COVID, when the team first moved home, and just all of the, high anxiety and fears and concerns that were on people's minds, and the beautiful way that the whole company came together. We were doing daily check-ins as a whole team to make sure just everybody was okay. And I think I found a rhythm that works in this remote first environment. But my belief is very similar to Mark's. I think human beings are social. And while I think we will see a permanent change to the way people work, where flexibility and the need not to be in the office 5 days a week, for those prescribed hours in the day is here to stay. But I think there will be a return to office space, and there will be a return to people wanting that social connection. We're already finding it. It's been a very difficult time for a lot of our employees who are outgoing, stuck at home. 2 working parents with kids in a condo environment is a very difficult place to work every day. And so we're still looking and searching for better ways to support the team in this environment. I'd say we're fortunate that it's working well. But I think I'm nervous about the winter in full transparency. I think the winter with people locked indoors, too cold to go out, will be a pretty lonely period for folks. And I have a lot of questions about folks' mental health, burnout, and how we're going to support kind of our team and Canadians broadly through this period, which will be very challenging.
It's a perfect plug. We have an event coming up later in November at the Canadian Club on how to make winter awesome and make sure we all keep our mental health strong. So
that's great framing, because I think inject some positivity into this, moment in time.
Exactly. You actually touched on a couple things in your answer related to real estate, how people are thinking about office space, how people are thinking about condo living. I'm curious, Mark, how you are thinking about real estate as an investment asset class. And that's a question I actually got from a viewer.
Yeah, so I guess I also touched on it a little bit. I mean, so first of all, it's a global strategy for us. So we invest in real estate from New Zealand to Brazil, and so that's the first thing. Nothing's been, virtually no country has been immune to this, but certain countries have come back. Obviously, New Zealand being one of them, in managing this pandemic pretty well. Australia's done pretty well. China's done pretty well, and we have decent real estate there. And then, those portfolios in Japan as well, so those portfolios done okay. I think in the spectrum of real estate, I said we don't do hospitality. The most impacted has been shopping malls. And so we do have shopping malls around the world, generally more in emerging markets where we still see the sort of growth prospects for it. But we do have big destination mall investments in developed markets as well, and they've clearly been impacted by social distancing and lack of traffic. The office I talked about is the big question at the moment, impacted, but I'm reasonably optimistic in the longer term. I'd say logistics real estate, we have a lot of exposure to warehouses. That's been a big strategy for us in both developed and emerging markets. And that's been terrific with the rise of e-commerce. And then obviously that's just accelerated during this crisis. And then the need for, just other logistics, supply chains getting more complicated for people, and the need for inventory. So logistics real estate has done well and continues to do well. And then data centers, we don't have enough data center. We have a bunch of investments, but not as much as we would have liked to have benefited from this situation. So that's that's an area of focus. But of course, it's an area where there's a lot of money looking at it, and so we have to find good the opportunities that still have good returns, but probably there'll be a bunch of those.
And a related question that's come in for you, Mike, on real estate, and is particularly how are young people thinking about investing in real estate, and is that still a good way to save for your future?
I've been known to have somewhat controversial views on this topic too.
Let's hear 'em.
I mean, listen, interest rates are at historic lows, and who knows what happens from here. And I think that as a result is making real estate feel more attainable for a lot of folks who are able to afford mortgage payments on homes, and excited about the opportunity to get into the market. The reality is that when it comes to investing in personal real estate, individual real estate, a home, I think there are lots of good reasons to buy a home. And in particular, if you can afford it. I think if you view real estate as the pinnacle of investment success, as the best or optimal way to invest your money, that's where I would take issue. I think it is better to build a diversified, long-term, disciplined portfolio. You can use a lot of the same tactics that make real estate wonderful. The things that make individual homeownership historically a wonderful investment is it's forced savings. You've got to pay that mortgage payment every month. And second is leverage. You take out a lot of debt to buy that home. And neither of those two things are unique to real estate. And I think that my personal belief is there are better ways to invest. However, there are lots of very personal, emotional reasons to buy a home. The thing I would caution folks, as a lot of young people that we deal with that are thinking about these sorts of purchases, I see a lot of young folks that decide to take out all the money they've ever earned, stretch as high as they can to buy the biggest possible house they could maybe afford, and then they put every dollar of cash flow that they earn into that house. And they sacrifice everything else in their life that they could afford to become a homeowner. They stop, ordering from restaurants or eating out if that was something they could have afforded before. They stop doing vacations. They might even choose, all sorts of other trade-offs that enrich your life, or folks might want to choose to actually be able to do to provide for their families and enrich their lives in that way. And I think people just need to be aware of that trade-off. It's not making a judgment if it's right or wrong. People just need to be wide-eyed and understand that there is a real trade-off there. And my belief is it's worth considering when you think about buying a home.
Actually, it's interesting. It's the one sector I out of the spectrum of real estate I missed out, because we invest a little bit in multifamily home where there's income, but we don't invest in residential real estate. In some ways, on a giant scale, for the reasons Mike mentioned, it's not income producing, and so it's a trading business, and that's something that we've been more skeptical on for long-term wealth creation. So we don't generally invest. There's a handful of very small developments, and we do invest in multifamily home where there's some income, but otherwise we don't invest in it.
I've got a lot of questions related to financial literacy, which was today's core topic. So let's bring it back to that. Do you have a view on how leaders can create opportunities for youth in the education system to understand pension plans and then financial literacy more broadly? Or who wants to take it first? Mark, we'll start with you with the pensions.
Okay. Having the fact I'm running a pension fund investment manager doesn't make me not disagree, or I agree with what Mike said about pension. Trying to get young people interested in a pension is pretty damn hard. It seems an interminable period away, and so the math around it. Hey, if I save $10 a day or $10 a week, I'll have $1 million, and but it doesn't really resonate with people. So I'm not sure that's the greatest thing to lead with. Again, in hooking people on, thinking about investing. I think there are programs in schools to get people just to understand, basics about the different types of way that you can invest, the different types of way that you can save. But I don't think it necessarily needs to be focused on retirement. We do spend time. I think people tend to get interested in retirement. I was looking at, again, some of the recent surveys. The most anxious about retirement seem to be the 35 to 54-year-olds. So that's well beyond school, but that seems to be the time where I think 76% of people are worried about how much they're going to have in retirement in the latest CIBC survey. And so that seems to be the time period people really start focusing on it. I think before that, just getting people, understanding that, the different ways that you can invest, the different types of markets you can invest in, and, having some fun in investing, I think is probably a better way of getting some traction.
Mike, you're nodding your head. You have some thoughts?
So one idea that I think is a no-brainer in so many ways, and because this is the Canadian Club and the time to pitch your ideas for the betterment of Canada, which will try to tie together financial literacy and equity in investments and access to investment tools together. I think that we should auto-default every child born in Canada into an RESP, which is the Retirement Education Savings Plan. There is no reason any child born in Canada should not have an RESP. And the reason I say that is because even folks that come from low-income families, we have a tremendous government-sponsored education program called the Canada Learning Bond, which says if you cannot afford to invest in an RESP, the government will do it for you and give your child $2,500 towards their education to start an RESP. And you can do that from the time your child is born. And I think this is one of the greatest things we can do for financial literacy. Every child with access to an investment account in their name from the time they are born to start understanding the benefits of compound interest, the ups and downs of the market as they go from childhood through to the opportunity for post-secondary education. I don't think there is anything better than actually enabling children to manage these accounts and teaching them the tools, with parents, with schools, but having real skin in the game and money at work would be enormous. And because the government has these equitable programs, there really isn't any good reason that every child in Canada should not have this set up. And then the second is that I believe this is a fundamental kind of necessity for the long-term health of Canada. If you think about Canada, we do two things in this country that underpins our prosperity. We pull things out of the ground and we finance that activity. And I think if that's still the story we tell ourselves in 20 years, we're in trouble. We have a necessity to continue to diversify our economy, and in particular, build more knowledge-based industries as big employers and job producers for Canadians. And the best way to do that is to educate our kids. And so give every kid access to all the funds that we have actually earmarked for them at birth for their education, and actually, promote an entire generation of Canadians to start thinking about school and educating themselves. This is such an important and kind of pet topic for us. We launched our own charitable foundation called the Wealthsimple Foundation last year, whose mission is to get 1 million kids access to the Canada Learning Bond over the next 10 years. And my actual objective is that we can close down that foundation because the government will just default every child into these accounts, and we won't need a separate financial literacy-based organization to go convince kids and parents that this is the right thing to do. So that's one big idea for financial literacy I'd leave with you.
I love it, and I love the passion. I'm curious, how is it going? And, it sounds like a great idea. So what are the barriers, if any, that you've encountered?
Well, it's going great. I'd say we're early days in our efforts. Our former company CFO, who's a remarkable leader, her name is Lean Lee, just left Wealthsimple to become the CEO of the Wealthsimple Foundation, and is really going to turbocharge our efforts to drive awareness, because that's primarily the biggest barrier. Is a lot of parents do not know that this is available. There is skepticism because it's free money, and not a lot of people trust free money without strings attached. And so we're trying to figure out ways to build trusted partnerships with community members across the country where we can build the trust and credibility required to convince parents to open up these accounts on behalf of their kids, because there really aren't strings attached. But we have a lot of learning and education and financial literacy building to go do, that our lives would be made a lot easier if these things just were auto default opened, perhaps even managed by the CPP, by the way, when kids were born.
Mark, have you seen programs that work well on financial literacy in Canada or even outside of Canada?
Yeah, the answer is nothing particularly spectacular that I've seen that works well. Obviously, a program where people are default opt-in, works incredibly well in all parts of the world. So I mean that's what we are as well. I mean you have no choice, and it's forced saving. And it works. I think it works well, as Mike pointed out. It works really well, and our returns are great. And we've grown. We're $450 billion today. We'll be $1 trillion in the early 2030s, but it's still not enough for most people's retirement. You're still going to have, for most people, you're going to have a significant drop in income if all you're doing is going to rely on your income from the CPP. You're going to be in the in the teens of dollars per $1,000 per year. So $16,000-17,000 to $20,000 a year when you retire, and that's for a lot of people, not for everybody, but it's a decent drop in income. So I think there's I haven't seen any spectacular magic bullet. There's various programs in Singapore and Australia engaging people in schools in different ways. But I love Mike's idea. I think it's a really good one.
Yeah, I love it too, because like you say, some of us that are a bit older remember that first savings account and the passbook and going to the bank. And now that you don't really need to go physically, it would be a great way to teach kids. There's nothing better than doing it yourself versus learning in a classroom, right?
Totally.
Okay, so we're down to our last couple of questions. And this one is for you, Mike. With Wealthsimple introducing cryptocurrency to its platform, what resources are available to assist people to become more literate with that asset class?
That's a great question. This was quite a controversial product launch internally at the company, because a lot of folks felt unsure of how aligned this was with our mission of helping people achieve great, financial freedom and outcomes in the long term. But ultimately, we launched it because we knew that a lot of Canadians buy cryptocurrencies today, and often on platforms that are hard to trust, outside of the regulatory regime, very little oversight. And we wanted to build a responsible platform that helped Canadians that wanted to do this learn about it and get access to it. So it starts by, if a client signs up for a crypto offering, it will be made abundantly clear that this is not a get-rich-quick scheme. It is highly risky. You have to kind of click through this multiple times before you actually start engaging in the product, versus I think other platforms that often try to gamify risky assets because that's where a lot of money can be made. We took the approach that we really want to be clear on the disclaimers, make sure people understand the risks that they're taking on before they would start investing in this space. And then in the product, we invest a lot in education, and we do things that might seem counterintuitive, like we published a blog post and sent an email out to clients around the launch of the 10 reasons you should not invest in crypto, to try to understand that, we know people do this. We don't want to be naive about it. And if you're going to do it, we want you to do it responsibly, but to understand the risks and really start to appreciate that component there. And that's not judgment to say it couldn't continue to become a more and more important part of the financial services system. I'm a believer that very well could be a future that is real. But people need to understand the volatility and the risk of that today. It's highly speculative.
Thank you. Interesting. Okay, well, Mark, I'll let you have the last word. I think most Canadians, working Canadians, are familiar with CPP as a program because it's a mandatory deduction. I don't think very many people are aware of CPP Investments and, everything that you described at the top. So, what's one message that you'd like to leave with Canadians to help them understand better?
Well, I think the key thing is the message I gave earlier, which is the fund is sustainable. That's number one. And so it will be there when you retire. Secondly, though, yeah, it's not enough. Third, that we as the asset manager of it are completely arm's length from governments, and we invest on your behalf all over the world to try and get that best risk-adjusted return in the long term. So we have about 1,800 people in 9 offices around the world working hard to deliver you a really diversified portfolio of private equity, of real estate, of infrastructure, of public markets, of funds, direct investments across the world. And so you get that is the bedrock of your retirement. And so take that. I think a lot of people often are, if you're worried about your retirement, you just get paralyzed into indecision about what else to do. But you should take some comfort in the fact that's going to be there. Broadly diversified portfolio is going to be there. It's going to be well managed in the long term. And then you can relax a little bit and then think about how else to plan and invest for all the things you want in life, not just retirement.
Great. Fantastic. So with that, we'll wrap up the discussion. I know we could have kept going. The questions are still coming in. So thank you, Mark and Mike, for your time today. It was a really important discussion. So we appreciate all of your insights. Viewers, we hope that you'll join us for some of our upcoming events. On Tuesday, November 10th, we are hosting Honorable Catherine McKenna, Minister of Infrastructure and Communities. And then on Thursday, November 12th, we are hosting that panel I mentioned on how to make winter awesome and manage your mental health amid the ongoing COVID restrictions. We'll be joined by Canadian Olympic gold medalist Rosie McLennan and others, so you won't want to miss it. Thank you again today to our sponsors, Canadian Bankers Association, Canadian Credit Union Association, and PwC for sponsoring today's event. Our events would not be possible without our sponsors, so we thank you for your generosity. Thank you to our AV supplier, Van Valkenburg Communications and LiveMeeting.ca for making it possible for us to come together virtually today. And guests, thank you for joining us. Stay healthy, stay safe.
Thank you.